Imagine a bank run, but happening like lightning fast, fueled by algorithms and a token called Titan.
Sounds chaotic.
It was. It's what happened with Iron Finance,
Yeah, Iron
an
Finance.
algorithmic stablecoin protocol that went from boom to bust in under 3 weeks.
Yeah, under 3 weeks.
It's wild. So it really captivated the crypto world.
I
It
did.
left many wondering, how could this happen?
Yeah, how could this happen? It's a fascinating case study, really, and a cautionary tale about the world of decentralized finance.
DeFi.
DeFi,
Yeah.
exactly. So today we'll be using Iron Finance's collapse as a lens to examine the mechanics of algorithmic stablecoins and the role of those governance tokens like Titan.
And our guide for this deep dive is a research paper
Okay.
titled Digital Money Creation and Algorithmic Stablecoin Run,
Catchy.
published in Finance Research Letters. We'll be dissecting this paper and exploring its findings. But think of this as a detective story.
Mm-hmm.
We're going to investigate what happened with Iron Finance, why it happened, and what we can all learn from it.
I like that. A detective story. So we're going to try to solve this case.
Exactly.
Awesome. Well, whether you're deep into crypto or just starting to explore DeFi, this deep dive is for you.
All right, let's start with the basics.
Yeah.
What exactly are we talking about when we say algorithmic stablecoin?
Yeah, so the idea behind a stablecoin is pretty straightforward. It's a cryptocurrency designed to maintain a stable value, typically pegged to a traditional currency, like the US dollar.
Huh.
Think of it like a digital version of a dollar bill.
Okay, I'm following so far.
But
But I know there are different types of stablecoins, right?
right, there are. So some like USDC or Tether are backed by real-world assets.
Okay.
So for every stablecoin in circulation, there's an equivalent amount of something like US dollars or treasury bonds backing it up. Algorithmic stablecoins are different.
Yeah, they're the ones that rely on algorithms and smart contracts to maintain their peg, right?
Yes.
Almost like a self-governing system.
Exactly. And often this involves a second token, a governance token. In Iron Finance's case, this was Titan.
Tighten our fuel for the metaphorical bank run.
So to buy iron.
Iron Finance's stablecoin.
Yes, Iron Finance's stablecoin. You needed $1 worth of USDC and some amount of this Titan token.
Yes, and the ratio of USDC to Iron created is called the target collateral ratio, or TCR.
PCR. Got it.
Yeah.
And if you wanted to sell iron, was there a similar mechanism?
Absolutely. You could sell one Iron and receive $1 worth of USDC and some Titan back. This ratio is called the effective collateral ratio, or ECR.
So these ratios, the TCR and ECR, they determine how much Titan was involved in each transaction.
Precisely. And because Titan's price could fluctuate the amount of Titan needed to buy or sell, Iron also changed. Now, one might think that relying on this additional governance token, a token subject to the whims of the crypto market, would make the system incredibly risky.
Well, it kind of does, doesn't it? It seems like adding a volatile element to a system designed for stability wouldn't exactly inspire confidence.
You're not wrong. But here's where Iron Finance tried to get clever. They incorporated USDC into their system alongside Titan, which in theory was meant to enhance stability.
So it wasn't a pure algorithmic stablecoin. They were trying to create like a hybrid approach.
You could say that by incorporating USDC, they aimed for a more robust system. If Iron traded above $1, the system would theoretically require less external USDC, potentially reducing its reliance on the more volatile Titan.
That makes sense. But our research paper highlights that despite this design, Iron often did trade above $1. So they weren't relying on that external USDC as much as they maybe intended.
That's right. And this, according to the researchers, could have increased the risk. Interestingly, they also found that Titan's price, despite Iron aiming for stability, experienced what they call bubble-like behavior.
Okay, hold on. What does that mean exactly? How do you even measure something like that?
They use something called the GSADF test, which is a statistical method commonly used to identify price bubbles. Essentially, it helps determine whether the price of an asset like Titan is increasing at a rate that's unsustainable and likely to be followed by a sharp correction.
So we have Iron the stablecoin trying to hold steady at $1 and Titan the governance token exhibiting bubble-like behavior. I have to ask, why would anyone want to use these tokens in the first place?
Good question.
Like, what's the point?
That's a good question. Let's start with Iron General. Stablecoins in general are designed to offer stability in a volatile crypto market. They make it easier to transact, especially in the fast-paced world of DeFi, where prices can change dramatically in a matter of minutes.
That makes sense. But what about Titan?
Yeah.
What was the allure of holding this governance token?
Well, Titan served two key purposes. First, it played a role in the stability mechanism of iron, as we discussed.
Right.
But secondly, and perhaps more importantly for many users, it was linked to yield farming.
Ah, yield farming. It's a term I've heard thrown around a lot in the crypto space, but I'll admit I'm still a little fuzzy on what it actually means.
Imagine a world where you could earn a high return on your crypto just by holding it or participating in certain activities. That's the essence of yield farming.
So it's like a high-interest savings account, but for crypto.
You could think of it that way.
Okay.
But with added risks, of course, yield farming usually involves providing liquidity to decentralized exchanges or liquidity pools and earning rewards in the form of tokens.
So in Iron Finance's case, people were drawn to Titan because it offered them a way to earn more Titan.
Exactly. Iron Finance used Titan emissions to reward users, and essentially bootstrap demand for both Iron and Titan users could earn Titan by providing liquidity to various exchange pools or by simply locking up their Titan in a staking contract.
It sounds like a recipe for explosive growth, but also potentially a recipe for disaster. Was Iron Finance the only platform using this kind of reward system?
Not at all. In fact, the paper compares Iron Finance's reward mechanisms to those of another algorithmic stablecoin, Terra USD, which used something called the Anchor protocol. Both aimed to incentivize users, but differed in the reward rates and the specific tokens used.
Okay, so we have this complex system with two tokens, a stablecoin trying to stay pegged to the dollar, and a volatile governance token driving speculation and yield farming. It sounds like there are a lot of moving parts and a lot that could potentially go wrong.
You're absolutely right. The Iron Finance story is a prime example of how these seemingly intricate systems can unravel and unravel quickly.
And unravel it did. So let's get into the anatomy of this bank run and see exactly how things went south for Iron Finance.
Let's dive in. So the beginning of the end for Iron Finance started, as you might expect, with large withdrawals of Titan and Iron from those liquidity pools we talked about.
Yeah, essentially people started pulling their tokens out, spooked by something, or things began to spiral. So what happened exactly?
That's a great question. And the why is always the most interesting part, isn't it? But we'll come back to that in a minute. First, let's unpack the mechanics of the collapse. These withdrawals had a massive impact on liquidity and price. Think of it like this: when everyone rushes to sell their shares of a company, at the same time the stock price plummets.
A classic example of supply and demand. In this case, the company is Iron Finance, and the stock is Titan.
Precisely. And the paper states that Titan's price took a major hit, dropping from $63.74 to $33.51 in a single day.
Wow, that's almost a 50% drop. So people see this massive drop in the value of Titan and they start to panic.
It's a natural reaction. This initial shock triggered what's known as a death spiral. That's a situation where the falling price of Titan makes people lose faith in Iron's ability to maintain its peg to the dollar. So they start selling off Iron, which further drives down the price of Titan, creating this vicious cycle.
So the stablecoin was no longer so stable.
Unfortunately not. With Titan's price in freefall, people rush to redeem their Iron, hoping to exchange it for a more stable asset like USDC. This massive sell-off and redemption of Iron ultimately caused the entire protocol to collapse.
So instead of staying at $1, Iron ended up trading significantly below its intended peg.
Exactly. It went into a death spiral, as we discussed, and ended up trading for as low as 10 cents. It's a stark reminder of the fragility of these algorithmic stablecoin systems, especially when they rely so heavily on the performance of a volatile governance token.
It really is. And the research paper actually dives into who managed to escape this crumbling system and how they did it. The paper mentions that 65.4% of Iron Finance users exited within just 2 days of the run starting. That's a rapid loss of confidence.
Indeed. Remember, this is a decentralized system moving at the speed of the internet. The researchers wanted to understand what differentiated those who exited quickly versus those who remained.
It sounds like we're about to delve into the psychology of a bank run, but in the digital age, did they find anything interesting?
They did. The research found that on average, more sophisticated users were more likely to exit, and they exited faster. They used proxies like address size time on the protocol and how Iron was acquired to gauge user sophistication.
Okay, can you unpack those proxies for me? How do those things indicate a more sophisticated user?
Think of it this way. Larger address sizes often indicate more experienced players, potentially with significant holdings, and who are perhaps more attentive to market signals. Users who had been on the protocol longer likely had a better grasp of its mechanics and were able to recognize the warning signs early on.
Okay, that makes sense.
Yeah.
What about the way they acquired Iron? How does that factor into sophistication?
Users who acquired Iron by minting it, a process that requires a deeper understanding of the protocol, tended to exit more quickly. Minting is more complex than simply buying iron on an exchange, so it suggests a higher level of technical knowledge.
So the people who really knew the system inside and out were the first ones to jump ship when things started going south.
Yeah,
Almost like they knew the house of cards was about to fall.
it seems that way.
Yeah.
And it's not just that they exited faster, they were also able to exit more profitably. They were more likely to redeem their iron for a basket of USDC and Titan potentially a more valuable outcome at that time, as opposed to simply selling iron at a depegged price.
So in a way, they were able to capitalize on the chaos while others were left holding the bag. It's starting to sound like a bit of a cautionary tale about information asymmetry.
That's a great point, and it's something the paper's authors highlight. If blockchain technology aims to democratize finance, how do we protect less sophisticated users from these inherent risks, especially in such a complex and fast-moving system?
That's a big question, and one that goes beyond just iron finance. What insights did the researchers offer? Do they have any suggestions on how to mitigate these risks?
Well, they do. They argue that more robust regulatory frameworks are needed, specifically designed for algorithmic stablecoins.
Okay.
This could include things like stress tests to assess the stability of these systems under various market conditions.
That makes sense. It sounds like we need ways to ensure these systems can actually withstand the pressures of real-world market volatility. Do they have any other ideas about how to better protect users?
Education is also crucial. They argue that a lack of understanding of how algorithmic stablecoins work was a major factor in the iron finance collapse. Many users were drawn to the promise of high yields without fully grasping the underlying risks.
Yeah, it's like that old saying, if it sounds too good to be true, it probably is. But how do we educate people effectively in a space that's evolving so rapidly?
That's a challenge, no doubt. But the paper suggests that platforms need to do a better job of providing clear and concise information about the risks involved. They propose things like risk scoring systems that are easy for anyone to understand.
It's almost like a credit score, but for DeFi protocol.
Exactly.
A way to quickly assess the level of risk associated with a particular platform or stablecoin.
Exactly. The idea is to empower users to make more informed decisions. The researchers also emphasize the importance of robust governance mechanisms within these protocols.
Okay, what does that look like in practice? How can we improve governance in a decentralized system?
One idea they propose is to move away from purely token-based governance, where voting power is determined solely by the number of tokens you hold. Instead, they suggest incorporating mechanisms that give more weight to users who have a proven understanding of the protocol's mechanics.
So instead of just money talking, we need expertise talking as well.
Yeah.
Sounds like there's a real need to balance the decentralized nature of these systems with the need for safeguards and accountability.
Absolutely. The iron finance collapse is a reminder that innovation in the DeFi space needs to be accompanied by a thoughtful approach to risk management and user protection.
Yeah, it's a powerful lesson and one that we can all learn from. This deep dive has been incredibly insightful. I feel like I've gained a much deeper understanding of the complexities of algorithmic stablecoins and the challenges we face as this technology continues to evolve.
I'm glad to hear that. As we wrap up, I want to emphasize that the world of decentralized finance is still very much in its infancy. There are many challenges ahead, but also incredible opportunities.
It's true. And for those of you intrigued by this deep dive, I encourage you to check out the full research paper. It's a fascinating read, and it will equip you with a deeper understanding of algorithmic stablecoins and their potential impact on the future of finance.
It's a space worth watching and one that